of conversations with ICC Australia. We are up to episode 23 now, so we're delighted to have not only that back catalogue, but a very exciting and interesting session to add to it today. Can I introduce briefly the two speakers who will be having the conversation today? The first speaker is Thomas Adams. He is an associate at Quinn Emanuel, based in their Paris office. He's been part of the firm's arbitration team and sort of more integrated in the Paris arbitration community since joining the firm a handful of years ago now. Tom has practiced generally in arbitration, commercial and investment, but has had particular experience in energy disputes, particularly concerning oil and gas and LNG. You'll see that that will be a theme across our speakers and our topic today. Our second speaker today, the other half of the conversation, is Phillip Solomon. Phil is based in Singapore and is the managing director of BRG's energy and climate practice. I think many of us on the call will know and will have worked with BRG across various jurisdictions, and will know that there is deep expertise within that firm in energy and climate matters. So having Phillip as the head of that group with us today is a real pleasure. I'm sure I don't need to say that Phillip has, I think it's more than 30 years experience in the oil and gas, LNG, renewables, power sectors, and numerous others as well. So with that introduction and the emphasis that I've given to both Thomas's and Philip's experience in the oil and gas and LNG sector, you'll now understand why the topic for today's session is what it is. So to read that out, to remind everybody, that is the APAC LNG disputes, emerging flashpoints and commercial insights. So what we're going to hear from our two subject matter experts today is a real focus on that particular topic in a region that many of us operate in and all of us have some sort of connection to. So it's a real pleasure in these conversation series to benefit from real expertise and depth of exploration of a topic, rather than hearing another summary which we've probably heard in many different fora before. So with many thanks in advance, can I pass over to you, Thomas, to kick off the conversation with Phillip?
Perfect. Thank you very much, Lucas, for the warm introduction. Thank you to Emily and Jacqueline for organising this. My name is Tom Adams. I'm joining you from Paris, where it's 7 in the morning, but very much looking forward to getting into a conversation with Phil on LNG and disputes in the Asia region. So why don't I kick things off to give this conversation a bit of structure? I'll open up with why Phil and I think that this is a topic that really warrants discussion, especially for arbitration practitioners in Australia and the broader ICC Australia community. So I'll kick things off with a broad overview, then I'll bring in Phil for a conversation, and we're going to have a very, let's say, we're going to look into 4 topics. First, market transformation in recent years. Then we'll delve into how industry has responded. And then we'll look at the disputes landscape. And then we'll finish with some thoughts about where we see disputes in the next few years. And then hopefully, if we have time, we'd love to get some questions from those on the call. So to kick things off, why do we think this is an important topic for discussion? Well, in recent years, there has been a significant structural transformation to global energy markets. And that has come off the back of 2 important developments. First, that has arisen from the COVID-19 pandemic, which led to a drastic drop in demand for gas, there in turn leading to a significant drop in gas prices, but also generally commodity prices. So that was the first shock. However, just as gas markets, global energy markets were starting to stabilize after the COVID pandemic, something emerged called the energy crisis. And this is a period between 2021 to 2023, where we saw unparalleled volatility of gas prices. And this was essentially brought about. The main reason this was brought about was that Russia curtailed deliveries of gas to Europe. And it's a fascinating economic and legal phenomenon. I think we can say what the energy crisis is to energy markets is what the global financial crisis in 2008, 2009 was to financial markets. And it makes for a fascinating case study because we had three things operating in tandem. First, from an industry perspective, as I said before, significant structural transformation, almost overnight. Huge changes to supply and demand routes, changes to LNG infrastructure, and significant changes to pricing and hub dynamics, particularly in Europe. Second, from a legal perspective, we saw this a bit during COVID, but especially during the energy crisis, we saw parties really testing legal remedies available under civil and common law jurisdictions. Things like hardship, things like imprevision, frustration, impossibility, rebus externibus. So given the volatility that was going on, parties were really testing these legal remedies, and international arbitration was, of course, the primary forum where those disputes were being contested. Third theme was obviously there's a geopolitical angle to this, right? There was enhanced concerns around security of supply, and that has shaped moving forward the global energy policy. So what does that mean then for Australia and for the APAC region? Well, if we have Russia falling out of the picture, what it has done is elevated three different sources of LNG, those being the US, Qatar, and importantly, Australia. And Australia's role in this changing landscape is threefold. First, recently, and I'm sure Phil will talk to this in a bit, is that in the recent decade, we've had a swathe of LNG projects in Australia coming online, particularly off the west coast of Australia. So what that has done is that it has elevated Australia as a primary source of gas, and now it is the third largest exporter in the world, accounting for roughly 20% of all exports. Second, Australia has really cemented itself as the primary source for Asian buyers. 90% of all LNG exported from Australia is going to Asia, and majority of that on long-term contracts. And that's particularly important because Asia is a region where a lot of LNG is consumed. I think roughly 2/3 of global LNG is consumed in Asia. And third and final point is that industry pundits envisaging that by 2050, the LNG sector will have doubled. And most of that activity is to occur in Asia. So Australia has really cemented itself and is in the perfect position to play an important role in that future. So I'm going to pause there. I've given a brief introduction, some very high-level observations of where we will go with this conversation. And now I think it makes sense to bring Phil into the conversation. And Phil, obviously, I mentioned things like the energy crisis, COVID, but very interested, of course, to get your thoughts on what have been the key structural changes in APAC markets in recent years.
Yeah, thanks, Tom. Phillip Solomon, Managing Director of BRG, based in Singapore, sitting in sunny Perth today, enjoying a bit of hot, dry weather. You did an excellent introduction, Tom. That was kind of a fabulous précis of the industry. But to talk about the structural changes and what's been going on in APAC, we probably need to look back at history a little bit. History informs us as to how we've set things up to be in the position that we're in now, which we can also talk about. But if we go back to sort of the early 2000s and so on, you're exactly right. Everything was, they were very considered projects, developed over a long period of time, signed up with long-term SPAs that underwrote the project financing. And it was pretty common to see, a 20-year SPA associated with a West Australian LNG project or a Northern Territory LNG project, an Indonesian, Malaysian, Brunei project, right? They were all very stock standard, underwritten under long-term contract. Then we went through a bit of a change. We saw a lot of LNG development in the east coast of Australia, the Gladstone Island projects in particular, which brought shorter contracts and multi-offtake contracts there. They were a dramatic increase in Australia's output into the Asia basin. And at the same time, we saw some decline in Malaysian projects and other projects through the region. So there was a bit of a change of guard, if you like. Around about the same time, we saw the US Gulf Coast go through a transformation as well. At one stage, they were going to be importing LNG, and those the brilliant scientists at the oilfield services companies discovered how to frack shale and release an enormous amount of gas. And those import projects were reversed and became export projects. So we now had the US Gulf Coast basin as a contributor to Atlantic trade and displacing what few cargoes were going from Asia into Europe. You mentioned, I should also mention the Canadian and Mexican projects. They contributed to more LNG supply into the Pacific basin. You mentioned COVID. So we fast forward, those projects in Asia, Australian projects in particular, are now online around 2015, 2016, getting up onto plateau and producing nicely. And we then have the disruption of COVID that you mentioned, and we then had the Ukraine crisis that followed on from that. So COVID demolished demand. The Ukraine crisis then quickly reordered how gas was going to be moved around the world. Russian gas no longer coming into Europe. It gets redirected around to China. China tries to redirect their cargoes. Many of those coming out of the Asian basin are redirected through to Europe. And you had this sort of shuffleboard game of LNG cargoes, which caused huge disruption for a year or two. We can talk later perhaps about some of the nuances of the contractual disputes that came out of that, but it was a significant disruption to trade. The Ukraine conflict itself caused probably the biggest disruption in the LNG markets ever seen. I was talking about those legacy contracts in the Asia basin, normally signed on a Brent basis. So it was a percentage of Brent as the LNG SPA price. And that was it. It just got adjusted by price reviews every so on to correct it. We suddenly saw Brent and the other indices that were emerging, TTF in Europe, for instance, or JKM in Asia, Brent and those gas indices suddenly diverged and dramatically diverged, hundreds of percent different. So we had the issue where we had perhaps a seller selling on Brent and a buyer buying on JKM, and that caused a huge disruption in price, or a huge arbitrage in price. Sellers no longer wanted to supply on that basis and were diverting those cargoes elsewhere, not supplying, causing disputes. So there was a huge period we've just gone through where we set it up in the early 2000s and in sort of mid up to about 2015. Then we sort of tested it through 2015 to 2026. These things are still dragging on, where we looked at those constructs and tested them in ways they were never intended to be commercially. So that's sort of that's a background. There's a quick history in LNG in the area.
Thanks, Phil. That's very helpful. And I think you mentioned there a point we'll pick up later when we get into the disputes we've seen in recent years, particularly about price reviews, when we had pricing mechanisms really distorted how parties went about, reviewing the contract price in such situations. On supply and demand, are there any topics on that worth particular discussion?
It's probably worth hitting on a few highlights there. Global LNG supply. I'm sure it's come to your attention through many forums. Global LNG supply is accelerating. It's growing at over 5% per year, particularly coming out of Qatar and the US Gulf Coast. They're contributing massive amounts of LNG to the market. So it's growing at about 5% per annum. Global GDP, on the other hand, is growing at about 3%. So there's a bit of a mismatch there, but that's not the whole story. There's a lot of energy transition inputs into that as well, which are causing that difference. But to put it in context, the global LNG output is, as of the end of last year, is roughly 500 million tonnes. Last year alone added nearly 50 million tonnes to that. So there was a 10% increase in the output last year, and that's likely to be repeated again this year. The bulk of that is coming out of Qatar. The dramatic increase in that supply is caused some observers to suggest that there's going to be an oversupply of LNG in the market between 2027 to about 2032. That oversupply, so some commentators, some analysts will suggest there's an oversupply. Others will suggest that there are market demand that's going to soak that supply up. I saw some interesting analysis, which was a little bit coincidental, but the amount of oversupply of LNG in the market, if converted to power via a gas turbine generator, would be about the amount of power that data centers forecast to need to consume over the same period. So, not to say that that's going to happen, but it was an interesting sort of data correlation. The interesting thing about LNG as a traded commodity is that price will set the absorption of those cargoes into the market. So whilst we know those cargoes are coming, the expectation from my perspective is that we'll see a softening in price and an absorption of those cargoes into existing users. Countries find ways to use the fuel if it's cheap enough. Qatar is the interesting story, though. Qatar and data centers are two themes that I love to talk about. Qatar will overtake Australia very soon as an LNG exporter. They have a massive field known as North Dome that they're currently developing, and it has the potential to bring on over a period of time, obviously, 1,000 TCF of gas. Now, to put that in context, roughly speaking, you need about 10 TCF to justify an LNG project. So the Qataris are sitting on 1,000 TCF. So when you think about the number of projects or the amount of LNG that they can bring into the market, it sets them up as a very significant player. Financially strong government and a very aggressive market approach. I think you'll see a lot from the Qataris. If I flip around the other way, though, to talk about other things, we talk about shipping. Shipping, I think, is the canary in the coal mine. So what's happening in the shipping sector tells us a little bit about what to expect in the market going forward. 2 years ago, you'd have to wait about 4 years for an LNG carrier or an FSRU to come out of a Korean shipyard. The Koreans make about 70% of the global energy transit infrastructure, seaborne infrastructure. That last year, that 5-year lead time dropped to about 3 years, and it's likely to be about 2 years this year. So you're seeing a backlog. The shipyards are chewing through their backlog of orders and delivering new vessels. A lot of those vessels are replacing older, less efficient, smaller vessels. But what we're not seeing is new orders filling those order books to anything like we have previously. So again, it's another signal that the market is softening.
Very interesting. And Phil, good to get your thoughts on the role of data centers that is playing in this. We may come onto this a bit later, but obviously data centers require a huge amount of electricity. Yeah. So whether LNG will be the primary source of that electricity or whether that will come from renewable energy, that could be a potential area of debate in the future. So I think we've put the broad structural points in place. Phil, I imagine we have a lot of lawyers on this call. So why don't we move into a more practical discussion now? So just thinking about how industry has responded, what are the key themes worth discussing on that subject?
The key themes I know we've got a lot of disputes lawyers on this call. So if we talk about the key themes in disputes, perhaps it'll be more interesting to the audience. But I think the recent history, the last 5-6 years, taught us a lot about the limits of SPAs as we'd come to know them. When I was negotiating SPAs, it was a pretty run-of-the-mill sort of structure. You didn't think about a lot of the things that have occurred in the last sort of 6 or so years. Repudiation of HOAs, where I mentioned before the separation of indices, where Brent and JKM had a dramatic separation. I know of one matter where a large seller simply walked away from a binding HOA. They said, we can't afford to sell to you on that when we can make so much profit elsewhere. So there was then a test of the strength of that HOA. Were you bound to continue with that contract? SPA non-performance. Sellers who simply walked away from contracts. Aware of one contract where the seller was selling roughly a cargo a month into an South Asian nation. The SPA contained a penalty clause for non-delivery, and they simply prepaid it. They sent a check and said, by the way, your cargoes aren't coming. Here's the payment for that, because the arbitrage in the pricing was so great that they could afford to pay the penalty without blinking. That became a test of the contract as to whether that was how the contract should be interpreted. Did you have the right to pay that penalty and walk away? So that non-performance of contracts was an area that became tested and has now, in more recent SPAs, been more carefully drafted. Diversion of cargoes. Again, that arbitrage that opened up, sellers were looking to divert cargoes to other markets and going to their buyers and coming up with constructs of how they might be able to do that, or how they might be able to share the profits from such a diversion. That's now becoming part of SPA normal constructs. They're putting into the SPA's formulas for working out how you would share the profits from a diverted cargo if you both agreed to it. And probably most importantly is the delinking from oil indices, where we're seeing fewer and fewer contracts now, which is interesting when we start talking about price reviews. We're seeing fewer and fewer contracts that are straight Brent. We're seeing hybrid contracts. They're a bit of Henry Hub, a bit of JKM, a bit of Brent, or time-based ones where they're one indice up to a certain point in time and then a new indice from that point going forward, which just reflects how buyers and sellers are seeing the market develop. But broadly speaking, we're seeing that delinking from oil indices.
Mm-hmm. That's helpful. And I think those discussion points will come on to shortly when we get into a debate about recent disputes, but it's very much, you're right, diversion of cargoes. What does that mean for legal remedies under the contract? And then also where we have significant price volatility, how do parties go about revising their price in such situations? Phil, just focusing on contractual readjustments, you picked upon there things like destination flexibility, profit sharing mechanisms. Are there other, let's say, contractual mechanisms that parties are starting to put into their SPAs or renegotiating into their SPAs?
They're probably the ones we see the most. The other interesting feature we're beginning to see, although I'll exclude Qatar from this comment, is we saw for a period of time very short terms. So we were seeing SPAs that were being signed for perhaps 2 or 3 years, where normally you would see them being signed for 10, 15 years. That reflected a nervousness in the market. It reflected a nervousness around the pricing. I think that has moderated. We're now seeing longer SPAs being signed. Qatar, on the other hand, is gone out there and demanded you sign 30-year SPAs or 20, 30-year SPAs, but offered you a very attractive price to do that. So they're trading off price for certainty, which is going to underpin those massive projects that they're doing. Other sellers, on the other hand, with more mature projects, are perhaps more willing to take a shorter term SPA or negotiate a shorter term SPA, but perhaps at a higher price, hoping that they'll be able to make hay while the sun shines before they're forced to renegotiate. But broadly speaking, shorter term SPAs are becoming less the flavour of the month. We're merging into mid and longer term contracts now. But that's probably the other main feature, other than the ones that you mentioned, Tom. Mm-hmm. It's the other main thing we're seeing.
What about the Australian LNG projects, Phil? My understanding is that they're usually longer term contracts, 15, 20 years, going to Asian buyers. Yep. These mid-term, let's say short-term contracts are perhaps a feature of Europe?
Feature of US Gulf Coast. So they're selling into a very different market. You're right, the Australian projects are quote unquote mature, with the exception of perhaps Barossa, which has just come online. But again, it was a brownfields redevelopment. And the bulk of that gas is going to SK as the partner in the project anyway. So the Australian projects are mostly legacy, although some of those contracts are going to come up in the next few years, are going to come up for renegotiation. The bulk of the Gladstone contracts, for instance, were 10, 15-year SPAs. They started in 2015, so by the end of this decade, they'll be up for renegotiation. The West Australian projects, for the most part, maturing, and they're selling into a different market or looking for longer-term SPAs to underwrite them. They're big, heavy infrastructure projects in a rather risk-averse part of the world. So those, you're exactly right, Tom. It's the US Gulf Coast contracts that are trading on a much shorter time frame.
Thank you, Phil. I think we have a question from Daisy Mallet. Oh, I see a hand up.
I'm just I can unmute myself. Fascinating conversation, Thomas and Philip. Thanks very much. I'm intrigued in the sort of term of these contracts in the context of the Paris Agreement energy transition, which is obviously a political layer that kind of sits parallel to all of these issues. And you've got the gas markets projection of doubling supply on one hand, and then you've got other international organisations saying no new projects at all, right? That's obviously not the way we're headed at the moment. But you talked about legal remedies being tested during COVID in Ukraine. Just interested to hear your experiences in any cases where these arguments around frustration and impossibility were raised, or whether you see in any of the contracts specific clauses giving off-takers the ability to either terminate or alter terms if there were regulations introduced relating to their emissions that somehow impacted their perceived ability to continue with the contract for that length of period on the mid to long-term contracts.
Okay, yeah. So there's a couple of themes in that question that we can sort of pull apart. So in terms of change of law is a common clause I'm sure you see in many contracts. So insofar as there's a change of law in either party, then there's usually an obligation to renegotiate that with an attempt to mitigate it. Imposts, in terms of a carbon tax in particular, is typically drafted into the contract such that the seller absorbs the impost. The price will be adjusted. The seller is in the market where they're trading in the commodity. They've bought the commodity. Are they generating electricity? Are they producing chemicals? What are their emissions? Their third scope 3 emissions associated with that. The seller has very little control over that, and I think that's recognised in the contracts that it's a buyer's obligation to deal with it. So the impost is typically passed through to the buyer. I think that was two of your points, Daisy. There was a third one there around Paris Agreement obligations? I think that's kind of covered
around how the extent to which you've had tribunals rule on issues around frustration and impossibility in the COVID or sort of Ukraine contexts. Have any of them been successful? And if so, a brief summary of what the factual matrix was. There's
some that are still going on, which I obviously can't comment about, but I think there's a lot of them have been tested. Well, a lot of them are trying different tests, let's say that. So they're running 2 or 3 arguments at once with the hope that one might work. The one that I have seen most common is force majeure. So they've called on the impossibility of meeting a contract because of international sanctions, for instance, and that the damages associated with that are significant when you're talking about long-term contracts. You're talking about infrastructure that has been built in one case where there was a very significant investment in infrastructure associated with the project, which can't be delivered because of the sanctions, let alone the commodity and the downstream part of it. We're talking about the pre-FID or the pre-commissioning costs. So I think force majeure and contract non-performance, I think many of those are still going through processes, but it's new ground.
And I think that's very helpful, Phil. I think one point I'd add to that, Daisy, is that obviously there has been in the energy space a lot of M&A transactions.
Yep.
So companies selling LNG portfolios, companies buying LNG portfolios. And if you were to buy a portfolio and the projections of the value of that portfolio was done pre-COVID, pre-energy crisis, based on, let's say prices of 10 euros per megawatt hour,
Yep.
and then energy crisis comes along and it's 300 euros per megawatt hour. Of course, you didn't factor that into your projections when you were purchasing the portfolio. So, I mean,
Correct.
It's a difficult exercise. This is where hardship and doctrines like Rebus 6 standardist come into the fore. And it's not a easy exercise, because essentially you're asking a tribunal to apply legal doctrines in situations that haven't been envisaged. So there's a legal element to it, but there's also the quantum element to it. It's very difficult to ask quantum experts to bring in these legal doctrines into these really strange scenarios, and without looking opportunistic. So it's not an easy exercise for tribunals legally and from a quantum perspective.
I'll give you a commercial response to that, and lend on the Latin caveat emptor. If you're buying gas to put into your market, it's your job as the buyer to understand that market and to hedge the risk associated with any fluctuation in that. So I see reflected in that little sympathy for buyers who have entered into a contract to buy a commodity and are then attempting to renegotiate the price based on the downstream impacts. Having said that, there is hardship clauses, I'm sure you're aware of, in the contract. The last thing, again, a commercial reflection, the last thing a seller wants to do is to send their buyer to the wall. If they have room and they have margin to continue the contract, or perhaps give some relief commercially for a period of time in exchange for something else, they might reshape the delivery curve. For instance, they deliver less cargoes at a higher price for a period of time, then they deliver more cargoes later for a different price. So there are commercial remedies to that. From a disputes perspective, I see tribunals struggling with those concepts, but my perspective is that it was the risk you entered into entering into that trade, not hedging yourself against the fluctuations and the things that can happen, and you have to deal with it.
It's a common legal argument too. How can you hedge against something like the like the energy crisis, which was beyond anything that had come through before? But Phil, perhaps that's a natural point where we go into a discussion of, what are the disputes we've seen in recent years. To me, I mean, there's probably two main themes: price reviews on one side and supply delivery disputes on the other side. Did you want to walk through price review, and then I can go through delivery disputes? Yep,
perfect. Price reviews typically associated with long-term SPAs that are on an index, a Brent, let's say, index here. For those that are unaware, typically come up between 3 and 5 years in most contracts, where you look at the seller or the buyer can call a price review, and you look at whether it's fair in the market. Is it comparable to other contracts in the market? That's the intention of doing it. You can see the obvious outcome there is that one party will want it higher, one party will want it lower, and there's an attempt to negotiate that out. What we're seeing in price reviews is, because we have a migration of contracts to other indices, JKM, for instance, we're seeing fewer and fewer relevant contracts. JKM doesn't require a price review. It just resets itself. It's an indice that's traded, and there's no need to have an adjustment or a price review if your contract is JKM or Henry Hub, for that matter. When it is indexed to another commodity like Brent, there is always the price review clause. So what we're seeing is a shrinking pool of relevant contracts. It's harder and harder to find a like contract, which most price review clauses require. It has to be a contract on foot at the time of the arbitration. It has to be a contract of similar volume, similar term, similar geographic region, all of those qualifiers. So by the time you go through and cut and dice them, you end up with an ever-shrinking pool of contracts to create the comparison to. So sadly, that's what we're seeing in the price review sector. The other thing I'll encourage any lawyer on the call to think about is time limiting your price review. There's one matter going on at the moment which unfortunately has no time limit to it, so it's just a feast of delay and deferral and going on. So it's frustrating all parties. So that's another recommended feature of every price review, is to have a time limit to the period in which it needs to be resolved.
And obviously, Phil, we're talking about in Asian price reviews then the comparative basis by which the tribunal goes to resetting the price. And obviously, that's a function of Asian markets, let's say, being less competitive or not being liberalized. Whereas in Europe, for example, you would see the parties in the tribunal very focused on prices in the end user market. And that the reason being that it's supposed that the buyer of the gas can resell the gas into the market, which is less of an issue in Asia, of course. So why don't I touch on briefly supply and delivery obligations, unless you had any more comments on price reviews, Phil?
No, that's price reviews in a nutshell. Yeah.
Yeah. Okay. So delivery obligations. Delivery disputes. So I think aside from price reviews during energy crisis, obviously in periods where there are extreme volatility to gas prices, that incentivizes sellers to redirect cargoes to places where the gas is more valuable. And this happened a lot during the energy crisis. There are some famous examples of Pakistan LNG. So companies like Eni, Gunvor had long-term obligations to sell contracted volumes of gas to Pakistan LNG. And when prices were high, they didn't meet those obligations. They directed the cargoes elsewhere to the spot market and profited handsomely. So I think if we think about gas price reviews, very technical, very economic. On the supply delivery side, they're more legal. They're raising interesting questions of law. And usually, if we're thinking about the Asian LNG scene, usually English law. So some themes that do come up are, first of all, in contracts, you may have, if we're looking at sellers' non-performance, the remedies that are governing that, you may usually have things like liquidated damages clauses. So that will say, seller, if you don't deliver the cargo to the buyer, buyers, your damage will be liquidated to, say, 20 or 30% of the price of that LNG. But of course, liquidated damages, there's always questions of how those are to be applied, and whether if the seller has been acting in willful misconduct, whether the liquidated damages clause applies. Second, there's usually an obligation on the seller to show that it has sourced or it has made efforts to source alternative gas. And this is based on the rationale that the buyer will likely need the gas. And this is probably a circumstance for Pakistan LNG. It had a real need for the gas. It wasn't on selling the gas. So what this does, this imposes a non-obsolete obligation. And that can be things like seller must use reasonable endeavors, all reasonable endeavors, best efforts endeavors. Lawyers who have worked on LNG SBAs will be familiar with those concept means, but essentially it imposes on the seller a non-obsolete obligation to show that they've tried to source alternative forms of gas. The third point I wanted to raise briefly is also one on damages. So if we think about damages from a pure common law perspective, it's to put the injured party in the place it would have been had the contract been performed. So in this situation, had the LNG cargo been delivered. But if we think about LNG as a fungible commodity, something can be traded like stocks or shares, there are interesting principles under English law, principles like the market rule, which establishes that the loss of the cargo may not be referenced by the actual price of the cargo under the contract, but instead the price at which the cargo could have been sold on the market. The idea being that if the buyer had the cargo when prices were high, it would have been able to sell the LNG on the market. So there are some interesting legal points I thought I'd just raise with regards to supply disputes. But Lucas, I just wanted to come to you quickly. I know we're almost at time. Should we go through very briefly some future where we think future disputes will be, or should we pause it there? And
can we have your elevator summary of future disputes, so sort of 30 seconds each, just to leave a little bit of time for any questions?
Sure. Phil, did you want to go first?
Yeah, there's a couple of things I wanted to jump in on, a few things that you had said a moment ago, but it kind of adds to the future disputes, where there's an interesting test around the price, the reasonable efforts test, and the price at which you are required to obtain a cargo. So it's one thing to find the volume. There's another test as to whether it's reasonable to pay an increased price. So I've seen a few disputes recently around that, and arbitrators have drawn limits to what is reasonable in that period, and therefore forgiven the fact that they were unable to resupply the cargo. Buyer disputes are another one. Non-performance of a buyer, especially when it comes to an FSRU, is another area. But that's probably all I can add in the time available.
Sure. I think for me, future disputes, I mean, we raised this before, there's a potential for oversupply. How that's going to play out in the future is anyone's guess, really. Obviously, we have considerations of data centers and other factors, but that could be a potential area for future dispute. There always could be future disputes. We're thinking about investment disputes around the phase out of fossil fuel projects, coal projects. So we're seeing this a lot at the moment in countries like the Netherlands and Germany and Europe. And then the last form of dispute is obviously there has been recent reforms to Australia's domestic gas security mechanism. And what that has given the country the ability to do is that in very, very exceptional circumstances to impose an export restriction. So the government would essentially be restricting the amount of export, LNG exported from LNG projects, which could give rise to future disputes, either from the projects themselves or the buyers in Asia. So I'll leave that there.
That's a really interesting one, Tom, because it effectively makes the government the buyer of last resort, or the supplier as last resort. There will always be a price mechanism, and it goes to the domestic gas obligation in Australia as well. There's no shortage of gas. The market will always tell you there's no shortage of gas. There's just a shortage of customers willing to pay the price that's required to develop it. So that dispute that you're referring to will always come back to what is the reasonable price that I'm being compensated at to supply you these volumes. If you're an exporter, it's going to be your obligations to your seller and the penalties you have to pay. It's a minefield the government is getting into, I think, in exercising those powers. But maybe just the threat of them is enough.
Well, Thomas, Philip, thank you very much. We probably have time for just one or two quick questions. I'll kick off with one and give the audience a moment to see if they have any. I was interested, Philip, in what you said around Korean shipyards. I've done a bit of work myself involving shipyards, though not in that jurisdiction. But some of what I've heard is that they are leading the world, not just in terms of output, but also in terms of use of robotics, AI, digital technology, all to streamline their production lines. Do you think that those things could be playing into the reduced waiting time, or do you see, as you say, that those reduced waiting times are canaries in the coal mine?
No, I think the efficiency is one matter, and I think that they're incremental gains. I think the wholesale changes we're seeing in slot availabilities or backlog, effectively they're eating through the backlog of orders they have, indicates that there's a structural change in demand for ships. The IMO, there's a couple of things going on there. One is size of ships. We're moving to a standardized 174,000 ship, which is the normal ship that terminals and floating off takers will demand. and we're moving to newer technology for propulsion, which is lower emissions and higher efficiency. So the old steam turbine ships are being retired and scrapped. So those orders, and the IMO have made those requirements law now. So we're seeing that structural change flowing through, eating into that backlog, the forecast for future demand. Those ships are being delivered over the next few years, but we're not seeing new orders post 2028 hit the books.
Okay.
Just
Any other
consistent with your
questions from
supply.
the? Thanks, Philip. Any other questions from the audience? No hands, physical or emoji, have gone up. So I think that leads me to say thank you very much to both Thomas and Philip for joining us on this conversation series. As ever, this type of industry expertise is fascinating for those of us who are more general practitioners. So we are all very grateful. With that, Jackie, we'll bring the session to an end, and I thank everyone for attending, and again, especially Thomas and Philip. Thank you, everyone.
Thank you,
Thank
everyone.
you, Lucas. Thank you, Thomas.